Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you guys how to make smarter trades. And today we're going to go over all of our opening positions that we had, all 5 of them, for Friday, August 8th. And Friday was actually a pretty busy day for us as far as opening new trades. And what I want to do is, before I go over all of the opening trades in detail, like we usually do on each of these videos, is I just want to talk a little bit about high level, kind of what the strategy is heading into this week that we had, and also heading into next week as far as where the market is and where implied volatility is. And I wanted to bring up a chart first of the VIX. So we all know that implied volatility has been generally higher, right? Or at least if you don't know that it is, you've probably heard me say it a couple times on some of these video tutorials this week as far as trades that we're entering. But the VIX really gives us a graphical representation of where implied volatility is. And you'll notice that pretty much the entire month of May, June, and most of July, we had the VIX kind of sitting below about 13 as far as a reading. And that really means that the market is pretty, non-volatile. It's trending higher. There's not a lot of movement either up or down. So implied volatility going higher does not mean that stocks necessarily go down. That's just what usually happens. But we had this kind of bulk area where the VIX was just in this kind of la-la land and the market was just trending higher. And that's really a hard time if you're trying to trade options as far as, strategies that take advantage of time decay and premium decay, etc. So during that time period, we had to do a lot of debit spreads, had to do a lot of calendars, things like that to just really kind of keep active in the portfolio. Well, now recently, as the VIX has continued to move higher, it's now way above 15 and has stayed above 15 for a couple of days now, and pretty much a week and a half it's stayed above 15. This gives us an opportunity where option premiums are swelling. So the same options that you maybe could have sold for 10 cents are now trading for 50 cents, right? So the premium in those options have swelled, and you probably saw this if you were selling some naked options ahead of this, which you shouldn't be doing with volatility so low, but I know that I've got some coaching students that sold naked options ahead of this decline in the S&P and saw their options just explode in value even though the market is nowhere close to where their strike price is. And that's because of this implied volatility going up. It's just swelling options on either end of the spectrum. So the plan going forward has been this week is to add a lot of premium, right? We don't get a lot of these opportunities during the year. And in fact, this year we've only had maybe 3 or 4 of these opportunities in total where we see high implied volatility that gives us an opportunity to sell option premium across the board, whether that's with vertical spreads or iron condors or butterflies or strangles or straddles, whatever the case is. It doesn't give us a lot of chances throughout the year. So because we have a chance now with implied volatility high, we want to do a lot of strategies that take advantage of selling option premium. Okay, and specifically, we're going to go about a month out to the September options. Now we did this basically all week. In today's video, we're going to cover some more of those trades that we sold option premium on. But that's really why we're kind of shifting away right now from debit spreads and calendars, things like that, because the market's not giving us that. So we're taking what the market gives us, and in this case, it's giving us a lot of high implied volatility, giving us a really good opportunity to make some trades that sell premium and potentially profit from time decay. So next week, if we start to see the market continue lower and implied volatility go higher, we'll keep doing what we're doing. So you'll notice today, as I go back to the chart here of all of our trades that we made here at Option Alpha, that our position sizes have started to increase. So we're starting to trade a little bit bigger positions across the board with these things so that we have a lot more capital at use, because this is actually a really good time to start putting a lot of capital to use. And we could definitely plow a lot more money into this market right now. And really what I want to see is, where it opens up on Monday. Do we continue lower? Possibly. We had a great rally at the end of the day on Friday, but do we kind of really reverse all of that on Monday and continue lower next week? That gives us another great opportunity to continue to plow money into this short premium strategy, which undoubtedly will profit from volatility dropping at some point between now and September. So as we start to head through these trades, obviously just keep that in mind. I just want to go over that kind of high level strategy talk. So the first trade that we did make today on Friday was MCD, which is McDonald's. We had traded McDonald's before. We had an earnings trade on that one. Went really well. And now we went back into the market. It's been really crushed actually and just heading lower. Went ahead and sold the 90, 87.5 credit put spread. So in this case, we sold the 90 strike puts. We bought the 87.5 strike puts to help finance that sale. and total took in a credit of 45 cents on each of those. So it moves our break even down to about 89.50 or so. If we go to the chart here of McDonald's, you guys can see just how low the stock has been. I mean, it's had really, really bad couple of months. And really our idea here is that we're going to play just a contrarian move, that at some point this thing is going to bounce up higher, right? That's the move that we're playing here. We're not going to play the continued trend here of McDonald's possibly heading lower. We're going to play a bounce possibly higher in the stock. Now, as I shrink down this graph, you see that our break even is all the way down here at about 89.50. So that still gives us a lot of room to be wrong and still make money on this trade, which is why making these trades during periods of high implied volatility when IV rank is above 50, and in this case it's up at 64, this is what gives us that extra boost in premium so that we can go further out of the money and sell options further away from the money, right? If implied volatility was lower, we only may be able to sell options really close to the money and take in the same premium but have more risk because we're closer to where the stock is currently trading. So by selling options with high implied volatility, you go further out of the money, which gives us a better opportunity to make money or higher probability of success. The next trade that we did is a butterfly, and this is just a regular straight butterfly in T. Now T was a little bit interesting. T is for AT&T, and I sent that out in the alert just in case people didn't understand it. Some of these single ticker stocks are pretty hard to catch because you're reading through this alert and you might just glance over it. But in this case, we did just a regular butterfly in T. So we did a 33, 35, 36 call butterfly, and we paid a debit of 24 cents on each of those butterflies. So in this case, we went ahead and bought the 34 calls, sold 2 of the 35 calls, and bought the 36 calls. So that really pins everything around this middle strike with these butterflies. That's ideally where we want the stock to trade, is somewhere around 35 between now and September expiration. And obviously, a drop in implied volatility is really going to help this stock. It's actually been really crushed, very similar to what's happening with McDonald's. So here's a look at where T is. You can see that AT&T and Verizon, all these guys have really had just kind of a real tough time over the last month or so. And notice, this is just funny, and I pointed this out on a coaching session to people, but AT&T actually jumped just about a week and a half ago, jumped from 35.5 up to about 37 in one day, made a huge jump higher. And I read a bunch of comments on blogs and stock tweets and Twitter and everything about everyone saying that AT&T was doing a breakout high, right? It was breaking out. It was now moving above the recent highs for the last 3 months. But at the end of the day, nobody knows what's going to happen, right? All those guys that were saying that AT&T was breaking out were dead wrong, right? Nobody was right. In fact, that was kind of like the nail in the coffin. You should have sold it that day, sold it on the breakout, and you would have made more money than if you bought it. So again, just really goes to show you that you don't have a clue. I don't have a clue where the stock is going. And therefore, all we can do is make high probability trades, control our risk size, right, and be on the right side of volatility. And that's what the name of the game is. So in this case with AT&T, we are a little bit bullish, and that's okay. So we're taking a little bit of a directional move, and we just want the stock to move somewhere up to around 35. So that gives us a little bit of room for the stock to kind of fall and maybe rally at the end of the month, whatever the case is. But ideally what we want is we want this stock to trade somewhere in the 35 range between now and expiration. And I want to go to the Analyze tab with this one so you guys can see exactly what the payoff diagram looks like. You can see it's a very even butterfly, so it's not like our broken wing butterflies that we usually have. And by buying this spread already in the money, you'll notice that AT&T is trading right here. And so we actually have a break-even point on the lower side that's below where the stock is trading right now. So if the stock were to just sit right here the entire month, we'd actually make about 50 bucks on this trade, or at least on each of the spreads. But again, ideally what we want to see happen is the stock trade up to about 35. That's when we make the biggest potential gain. But our window of opportunity is anywhere from about 34.24 to about 35.75 or so. So a pretty big window of opportunity still for us to make money. That's why we like this trade. Options were very well priced, so we're definitely adding that to our whole portfolio and kind of getting a little bit bullish. The next trade we made was in Yahoo. So in this case, in Yahoo, we tried to, again, even out our portfolio as far as put spreads, credit spreads. We don't want to be too one-directional in either way. And with Yahoo, we've noticed that Yahoo's had a real tough time kind of breaking above some levels. and it's been a recurring theme for Yahoo over the past couple months that we'll talk about in the chart. But in this case, we went ahead and sold 4 of the Yahoo September 38-39 call credit spreads. So we sold the 38 strikes, went back in, bought the 39 strikes. The total that we took in is 26 cents in credit for those. So really good trade, great premium, high probability trade. For Yahoo, when we bring up the chart here, you guys can see that it's just had a really tough time kind of breaking above this 37 barrier. And you'll notice that it's kind of hit its head and run up to that 37 barrier multiple times and really fallen away. So for us, that's going to be a hard line in the sand for Yahoo to get away from. And we think that trading just above that level at 38 is going to be a good trade for us. It gives us a lot of margin for error. And obviously, if Yahoo kind of falls out of bed, then that works too. This trade only works, as we've discussed already a lot in this video, because of high implied volatility right now. So Yahoo still has really high implied volatility. Although we're past the earnings event, which usually creates a big drop in implied volatility, we still see a lot of potential movement in Yahoo one way or another. And the way that we decided to play this trade was to do a call spread above the market. Now, I had a lot of people that asked and said, hey, can we throw in a put spread and do an iron condor? Absolutely. So you could throw in the 34.33 or the 33.32 credit put spread and create a big iron condor in Yahoo. So if you're not one directional, if you don't have an underlying bias and you just want to see Yahoo potentially just kind of trade in this range all the way through the rest of the month, which I don't think is possible that it can do that, but it may be, then you could go ahead and throw in that extra put spread below the market. You're still trading high implied volatility, which is ideally what you should be doing. Okay, speaking of iron condors, we did make a pretty big iron condor trade in XLU. Really like this XLU trade. XLU is the utilities ETF for the S&P 500. Really, really good implied volatility. It got down pretty far over the last couple of months. Again, with the regular markets been going lower, but this tends to be a little bit of a slow mover in just trending markets. So what we're doing here is playing the possibility that at some point, if the market does start to rally higher, this thing will start to rally, but it will be a much slower moving ETF as opposed to some of the other big names like XLF, XLE, etc. So in this case, we went ahead and did the 43.44 call spread. So that's our call side, the 43.44. And on the put side, we did the 39.38 puts. So that means that we ideally want XLU to trade between 39 and 43 between now and September expiration. That's where we want it to close, between 39 and 43. Again, if we go to the chart here of XLU, you'll see we had a pretty big rally here at the end of the day, but it just has really monster and high implied volatility right now. It's up in the 80th percentile, which we haven't seen in a long time. And you can see it's a very calm stock, right? So it makes just very general moves. It's not a big mover, $1 to $2 a month or so. And so we did our strikes at 43 up here and 39 down here. So it gives us a very, very large window of opportunity. This thing can travel all the way up to 43. We still make money. It can fall all the way down to 39 and we still make money on this trade. Very, very high implied or probability trade for us. If we go here to the Analyze tab, you can see where our Iron Condor is set up. And so this is what it looks like. Very, very tall, great Iron Condor, wide at the top because we have a very wide window of opportunity to make money on this trade. And you can see that our pivot points are right here at 43 on the top side and 39 on the bottom side. So it's actually trading a little bit higher after the rally on Friday, trading a little bit higher than when we entered it. When we entered the trade, it was right around 40 or so. So had a pretty good move on Friday, and that's okay. What we want to see is we want to see it not trade too much higher past 43, or at the very least, fall down to somewhere around 39, and we can keep this entire premium or credit that we took in. All right, and so the last trade that we made here today is on USO. So we went ahead and sold out of, or this should actually be a closing trade, so I apologize. This should actually be a closing trade. We went ahead and sold out of our USO calendar spread. We had originally traded the 37 put calendar spread. I believe we got it for about 33 cents from what I remember. So this really means we made $1, which is really nothing after commissions. We kind of scratched on this trade. So again, this will be adjusted back down into the closing section. But the whole idea here is that we got very, very close to August expiration with USO. the calendar really didn't move. We were pinned around 37, and it definitely traded through 37, but hasn't really come back up to that point to make any significant profit left over before August expiration. So at this point, it's a scratch trade. We're kind of using the capital elsewhere, so we don't want to tie up capital in calendars and debit spreads that are really low probability trades. So again, that should be into the closing column, and I will definitely move that after this video. As always, if you guys have any questions or comments, please ask them right below. If you're watching this video somewhere out there online on YouTube or Facebook or Twitter, you just have to understand that this video is actually coming out to you guys about 15 days after it's sent out to just our members at Option Alpha. So if you want to get these trading alerts real time, email and SMS text alert, and you want to get this video tutorial every night covering every single trade that we make, you've got to sign up for the free trial at optionalpha.com. You get everything that we have in there. You get to kick the tires for 7 days. Try it out, see if it's something that you like. If you have any questions, please let me know, and happy trading.